Everybody's aware what we got coming up, right? What do we got coming up? Anybody? What do we got coming up? That should be on the minds of everybody. Memorial Day, but summer. And I'm sure you guys have heard that old trading adage, sell in May and go away. I got to be honest, I love summer trading. Well, real quick, Ryan, we don't always get a sell-off. As a matter of fact, the past 2 years, there have not been a traditional summer sell-off. As what we would normally expect. But what we do get in the summer, and what we even got last year, was a little bit lower volume. Actually, a lot of bit lower volume. But that doesn't mean you can't make good quality trades. For me, each and every year, the third quarter is actually my best quarter. It has been every year I've been trading. And I wouldn't have the third quarter I do if I didn't have the summer to trade for that third quarter. But your approach to trading in the summer needs to be a little bit different, and let me tell you why. I'm sure you guys have all seen days here and there where it's like you might gap up or gap down, but then you don't move very much. You guys ever seen days like that? No, there's been trades to be made. Today wasn't just flat. It had periods of flat, but it was during the time where everybody would expect the market to be flat. Friday was pretty bad, but we have those sporadically through the year. Believe it or not, come summertime, they're less sporadic, more consistent. So that gets some people all disappointed, but let me tell you, I've always actually traded better in the summer than other times. Because with that too, what else do you think you have less of? If there's less craziness, there's also probably less manipulation. And remember, a large part of how any stock moves is how whoever the biggest person trading it is moving it. But we do have the less volume. And what you're going to find regularly is you'll have days here and there where you get some volatility, and if you're day trading, you day trade your options, and you're going to have days that you do well. If you are not going to allow yourself to expand your horizons into trading that can be more successful over the summer, you could have a difficult summer. And I'm not going to sugarcoat that, because I want you to know that and understand that going into it. But I'll be honest, even how I do my swing trades changes a little bit in the summer. It does change a little bit in the summer. For instance, usually this week and maybe even next week on my swing trades, I would still be buying June 19th. I put out some swing trade alerts on Monday. What expiration did I buy? No, I bought the 7/17s. For the majority of the trading I was doing, unless it was something I was adding to an existing position. Well, the reason why is to start a fresh position going into the summer, you have to take that assumption that the market could be a little bit slower. It doesn't mean it can't move. Let me start by giving you a couple examples here. I'll bring down a weekly chart. And we'll go midsummer 2013. Literally the dead middle of summer, July 15th. Facebook went from $25 to $40 in 2 weeks. And actually, then by the end of August, was up near 45. But then you get times like, let's look here at Netflix. That isn't really a sell-off, but you know, you look at this weekly chart for Netflix, it's like usually going up or down, right? There's 3 directions something can move, up, down, or sideways. And usually Netflix is moving up or down. But the summer of 2013 there, can you see that where it pretty much just stayed flat? My microphone not working? Okay. And we get this oftentimes, but then you look at last summer. Here was this current week, last week of May, that was when it broke out. And then by the end of the summer, it was coming right back down to double bottom. So you don't want to approach it like it can't move on any stock that you might trade, but you do want to approach it like it can move slower. Let's face it, if we maybe thought on this breakout here 2 summers ago that Netflix was breaking a swing high and we could take a swing trade, if we were taking our normal like month out, we would have gotten hurt by that trade, correct? Because if you look at it here, if we're trading a month out, 1, 2, 3, 4, or even the 5th week, we didn't really give ourselves a chance, but it didn't fail support either. You see that back here? It just took its sweet old time resting along that same support level for actually 4 of those 5 weeks. But had we given ourselves the extra month, we would have had a little better chance, right? Now, really, what I'm going to talk about tonight is a principle that you could trade year-round with. Sorry about that. Anyway, what we're going to talk about tonight, and a way that I trade towards the summer, you could do anytime throughout the year. But if you're trading a little further out for expirations, what do we know about usually that what your average volatility could be on the options farther from expiration as opposed to closer to the expiration? Yeah, you know, they could move a little slower. Now, they might cost a little more, but I'll be honest. Nearly 100% of the time, like quite literally like 99.9999999% of the time, you're better off to buy 1 contract for $1 than 4 contracts for a quarter. People think cheaper is better. Those people usually don't do good trading. Just putting it out there and being honest. Cheaper is not better. Cheaper is way more dangerous, and such a small chance that you'll actually succeed with that trade that when it actually does have the opportunity that it turns into a big trade, you're probably broke before you had that opportunity because you lost it chasing all the other ones that way, and now you just had to watch the other one because you don't have any more money. So, you know, the higher price for them, that's really not a big deal. But with less volatility in the actual option itself, what does that say about your risk? Absolutely. Your risk will decrease, which, not to take George's job as Captain Obvious, but most people aren't here because they have problems managing reward. They're here because the risk is the difficult thing. So to manage the risk a little better is going to be more in our favor. Now, typically the way I do the majority of my swing trades, how do I like to buy my swing trades? Oh yeah, I love to scale into them. And I like to do that in the summertime too. But I am more picky about which trades I take. And also, the reason we're doing this lesson tonight is because sometimes I might be a little more confusing in how I build the positions. Now, we've already determined that trading closer to the expiration is going to give you a chance at higher volatility in the actual price of the contracts, which means my risk is more, but my reward could be more percentage-wise. And, part of me still says, hey, even though I'm not a big-time day trader, I still like some of the shorter-term swings so that I can have some higher volatility moves on it. Basically, my approach to the summer is I actually take some of the same trading principles that I would normally use, and I move them back one time frame of chart. What do I mean by that? No, not exactly. Let me show you what I mean by that. Normally, when I plan my swing trades, I plan them off of what chart? A daily. I don't plan swing trades off of 60. I plan my swings off of a daily. So if I moved it one time frame farther, what chart am I going to use to plan my swings? There we go, the weekly chart. Now, some of you joined me in the chat room today, right? And some of you actually have either told me in the chat room or even emailed me that today was probably one of the biggest aha moments or lessons you've learned yet. But those of you that were here in the chat room today, what was the biggest lesson you learned about when the best time to really buy options is? Absolutely, on the breakout. What I mean by that is even if we looked at it on this weekly chart, the occurrences are so few and far between that it would actually be best to take your calls play here as opposed to here when it breaks out. You got one top, two top, three tops, and you broke out above it, right? Let me move that line to really demonstrate what I'm talking about. Multiple tops here, and then we broke out above it. Most of the time, you're actually better off to make your entry in options on the breakout. why are you better off to make your entry in the options on the breakout? Because that momentum trade really goes into effect. Is it actually possible that you could have bought at the low of the stock, but it even take a couple months to even go anywhere? Is that possible? Or that you bought at the high, but it took a good solid month to do anything? Very possible, right? And that's even on one of the most volatile stocks in the history of the US stock market. So trying to be the person that buys at this very bottom low wick as an options trader, it's not a good thing. Why? If you're trading the common stock, it can be a great thing. Why is it not a good thing for options? There you go, the time decay. And most stocks will consolidate around their tops and bottoms. I mean, if you look at this chart, would you say Netflix likes to consolidate around its tops and bottoms? Yeah, there was 9 weeks of it at a bottom. Here's 13, 14, 15 weeks of it at a top before it broke out again. Here's 6 weeks of it before another breakout. Right here, I mean, if you look at that, you moved in 4 weeks, you only got $1.80 higher before you went any lower. That's right there is pretty much consolidation through there. 1, 2, 3, 4, 5 weeks just to be exactly where you started. That's consolidation, isn't it? 1, 2, 3, 4, 5, 6 into the 7th week before you actually moved anywhere. That's consolidation. You could even say that all right there is consolidation. This over here is definitely consolidation. Even this right here was consolidation, wasn't it? So, and this is on literally the most volatile stock in the US markets. The largest percent gainer in the S&P 500 in the last 3 years. 4 years now. So, pretty safe to say that it's very easy when using the proper charts to see how consolidation can exist. Also, when you look at the majority of your consolidation periods, they're generally in that 3 to 5 week mark. Now, that doesn't mean all stocks will go sideways for 3 to 5 weeks at a top or a bottom. Look at this here on Netflix. You ran up huge. 1, 2, 3 weeks. 4th week was the breakout. It's a very regular occurrence. And because of the notable lower volume in the summer months, it'll be best to give yourself that extra month to trade as opposed to what you normally do. Now, not to get too far off topic, do you know what also actually happens to happen in the summer that's almost like the reward for being here for the summer? It's the time when the day trades are better The times when the gaps are generally larger than the rest of the times in the year. And where your premiums aren't inflated as much as they are 3 other times during the year. What might I be talking about? Earnings. The summer earnings is actually one of the best earnings to trade. You know, for the first quarter earnings, you might pay 6 to 10 times fair value for Amazon options. And in the summer, you might only trade 2 times fair value. The rest of the year for Facebook, you're going to trade 4 to 6 times fair value for options. The last 2 summers, the summer quarter has actually been traded with hardly any premium inflation at all. Like not even anything noticeable. It's like a little more of a fair shake as like a reward for the summer. But back to the swing trading, we want to give ourselves the extra month, but we also want to focus on what? Buying what types of scenarios? See, we got to stop thinking of trading like an investor. A lot of people like to think about trading. They want to be a trader, but they think like an investor. And for our summer trading, we do not want to buy the what? We don't want to go long where? We don't want to go long at the bottom. We do not want to try to call the bottom, especially during the summer. Where do we want to go long at? Not necessarily the top, but a breakout. And where do we want to go short? We don't want to call the top. We want to do what? And it'd still be a breakout, but we wanted to break out of a current pattern. For instance, let's take a second and forget that right here, Netflix went up, okay? Forget that the last 7-8 weeks exist. If it was during the summer and you wanted a fair shake on premiums, you want to let it break down below here. Literally, you would want it to fail this red line to break out of this consolidation channel. And you could say, man, that's like a $100 consolidation channel. Well, that's actually $150. That one would probably be okay to trade in consolidation, okay? But look at your tops and bottoms on that. You had tops and bottoms that were the majority of the time, and then like one candle that moved, right? Look at that. Consolidation, consolidation, one candle. Consolidation, consolidation, one candle. So when you're doing your trades, you want to identify patterns on a weekly chart like multiple tops, multiple bottoms, a consolidation range. What other type of pattern could we think about when it comes to talking about breakouts? W patterns. We can actually see a W pattern here on this chart. You know, back there at this bottom down here, where we got the double bottom, and the time to buy isn't off the bottom, it's when it breaks out above it. Head and shoulders, yeah, got a couple head and shoulders examples we can show. Tesla had this head and shoulders here that we were waiting to fail the neckline. Oh, guess what? It's making the right shoulder right now while we're waiting for it to fail the neckline. And you see the left shoulder, the head, the right shoulder. The right shoulder's not defined right now because it's actually a W breakout too. We also have that head and shoulders on GMCR. Everybody see the head and shoulders pattern? This one should be easy. It's actually written on my chart. We had a head and shoulders on Baidu. Cup and handle breakouts are very reliable breakouts. And if you ever find a prettier one than that one, please tell me, because that is the prettiest cup and handle I've ever seen in my life. It looks like it was drawn just for a textbook. Does everybody see why that particular pattern right here is called a cup and handle? It looks like a little teacup, doesn't it? You got the rim of the cup and then the little curly Q handle. So these type patterns can be very highly reliable for the breakout. But remember too, that using your weekly chart, you can actually find more definitive ability to plan your trades. I'm not saying necessarily entering off of your weekly chart, but to plan your trade off the weekly. And why I say this is the breakout patterns from your weekly, well, the higher the time frame of the chart you're looking at, the more of effect it seems to have, right? I mean, I can have a head and shoulders, which is a bearish pattern, on a 1 minute chart, and it dropped for one candle, and then, well, on the 5 minute chart, man, that was a W. Here it goes. It's taken off. Which chart do you think is going to win most of the time? A chart pattern shown on a 1 minute chart or a chart pattern shown on a 5 minute chart? Yeah, the 5. And what about like between a 15-minute chart and a 60-minute chart? Yep. And then same goes for between the daily and the weekly. The weekly is going to have a little more definitive response. Now, another thing to kind of think about here is while you're identifying these trades for your summer trade planning, do you want to just be really wasting your time watching something that, well, it could go up a little bit or it could go down a little bit? Or is there something else you might want to be looking at? As far as I'm concerned, playing the red candle, green candle game is pretty well just stupid. any time of year, let alone in the summertime. But once we determine a potential breakout pattern, what do we want to be looking at to see if it's even worth us continuing to watch it? No, because there's not going to be much in the summertime. I about promise you the volume will go down to about half the average daily volume. And see, that's where I think a big mistake people have. You know, they play the red candle, green candle game, and they stare at a couple charts, and it's like, okay, well, I think Apple could go up, so they buy it, and you know what? It might go up, but it might not go up very much, or it might not go down very much. We need to be looking for opportunities that could grant the highest potential move, right? We want to be looking for what even has the potential at a bigger move. Now, there's some that would surprise you that, man, you know, I didn't think that had the potential for it, and dang, look at it now. But for the most part, the swings that you'll be given will actually be consistent with how you would normally target based on a particular chart pattern. So let's just run through a couple rules that are important to have for how to trade specific chart patterns. A W pattern. When you get a W breakout is not very difficult. Actually, we go back to Tesla. Saw that W on the weekly. Do you see where it looks like the letter W right here? You got the long lower left leg, a lower high, a double bottom, and then a breakout of the center of the letter W. It literally looks like this. Do you see that? What we want to target, and I'm not saying to sell right at the target, what we want to target on a W breakout is the highest close after the start of the fall. That can be a little bit tricky at times because in reality, after the start of the fall, that right there was the highest close, wasn't it? Because you had an up move that started pulling back, and that there was the highest close at the start of the fall. Wasn't this one also a highest close at the start of the fall? Or after the start of the fall? And this here as well. Now, there are times where you'll exceed that. There are times where you'll see a W pattern actually trade to a prior high. But it'll happen much more consistently that you get to the highest close after the start of the fall. And that doesn't mean sell immediately at that line. It means sell if it does what from that line? So we'd want to sell calls if it goes up. It's a W pattern. It's a bullish trade. It's a long trade. Yes, if it hits a line and pulls back from it. If it hits resistance and retracts from it. What if it breaks above that line? Then that line becomes your stop. So like for this week here, we would actually make our stop this red line right here, right? If we played that W break, and now we're above this line, that red line would become our stop. Would we still be in that trade? Yes, we would. A head and shoulders pattern, what do you mean if it keeps going? It didn't go back below that line yet, so we would still be in it on a W break trade. Don't try to call the top of a swing trade especially. Or else you would have thought this was the top and 2 weeks later went, crap, I wish I would have held it. Trade according to your stop, not where you're assuming the top could be. Because anybody that sold any stock since 2009 was probably wrong on the top. If it goes back below this line right here, Trini, you've got to be willing to give back some for the ability to make more. And then if it were to break above this red line, that red line would be your stop. So for a W pattern, where do we want to target for a W pattern? Yep, the highest close after the start of the fall. So that means, like here, I've got this marked. It wasn't the close of this candle, it was actually the next candle because this was the start of the fall, and it just so happened the next week closed higher than the week before. So the first close, or the highest close after the start of the fall. How about one like that cup and handle we were showing on NEM? Where do you target on a cup and handle breakout play? I'm liking that answer, Paxton. Here, and then here, and then there. And there. The highest close after the fall had started, right? You will actually find a higher percentage of them will hit that highest close after the start of the fall than that would go up to the prior swing high, even though it might seem so close. So if you simply allow yourself to, once you cross above one of those red lines I have, let it serve as your what? As your stop. So if we get up in this area, our stop would be this $32 area, right? If we got up into here, our stop would be right there around 40 bucks, 39.50 or so. If we got up into here, our stop would be falling back below 45. Very, very simple to trade based on chart patterns. Now, what about a head and shoulders pattern? You know, we can get lucky and buy it early. Well, Trini, that's a good question. Here, let me go back to like NEM right there. You mean if it doesn't go up to one of those red lines? Chances are it'll fall back below this green line and then you'd be stopped out. Yeah, the breakout point is your stop. That's why there's a very good risk to reward ratio on breakout trades, because you're waiting to buy them on the breakout, not 3 weeks after the breakout, not, oh man, everybody's been talking about this stock running like crazy. Maybe I should buy it. Oh shoot, they're selling it. That's not where you buy it. Which means you have to be prepared in advance. Which is why we got a 1/3 position of NEM calls when it was on the handle. So that when we averaged up, when it broke, or if it were to break out, or assuming it would break out, we'd have a really good average then, especially after the $5 move. To talk about another chart pattern, let's talk about a head and shoulders. And where should your target be? And we're only targeting first target, because to ever get to your second target, you've got to get through what first? To ever be able to get to a second target, you've got to go through what first? Yeah, you got to get through your first target. So don't even think about the second one until you're past the first one. A head and shoulders pattern. It is a breakout pattern when it does what? And the reason we're talking about breakouts is because that's where the momentum trade is created. That's where you're going to have a higher likelihood of making profit, even if you did not call the high or the low of that stock. The neckline failure. So GMCR, we had a neckline failure right here, right? Everybody see that? Does everybody see that this was our neckline failure? And where do you target for your trade? It should be pretty easy because you see it on my chart. And this was a trade I made. On a head and shoulders, when it fails that neckline, you want to target the prior low. That makes sense with where I have my line there? So that low right there, that was the last low before the head and shoulders pattern started, right? Because I got a left shoulder, a head, a right shoulder. So that's my prior low. Now it is possible that fails, and you'll find out with chart patterns, you're really talking about swing point trading. So if that line fails, you'll target this swing high, which could serve as a support, which more than likely will serve as a support. And if that fails, you'd target at this swing low, which you notice right here was another breakout, and this was actually a retest of that breakout, right? See the consolidation, and then boom. Then it dicked around for 3 months before it retested the breakout point and moved again. So like right now, my target is what? My target right now is what? The green line. And where's my stop? There you go. But when I was preparing for this trade to potentially happen, where was my target? When the chart only looked like this, and I'm like, wow, that looks like it could be a head and shoulders, but I'm not going to buy yet. So as I'm planning my trade and waiting for my entry, where's my target? That red line about 90.60, right? 90.61. And then I wait for my entry. Now, here's the other thing you want to kind of keep in mind. And it's the next part of what we're going to talk about. Now, this pattern was identified on a weekly chart. Now, if I wait for the weekly candle to close, I could still have a good probability in the trade. But, you know, if this thing's already dropped 15 bucks, I'm really not going to feel like I'm getting a good deal on it. This is actually where I do use the daily chart. Now, see, all these lines and everything was from my weekly chart. And I'll make some other just subtle little simple observations. Like, okay, even though that longer line, this red line was my neckline for my weekly chart, I did have a couple daily closes a little bit below it. So if I get a daily close below that line, rather than waiting for the whole week, that could be my entry, which could have had me entering on 5.5. And then, as you can see, was able to hit my target. Not at all. An M pattern would have to be a double top. So I guess if from right here it went all the way up to here and then came all the way back down to fail the center, then it would be an M. And that's a lot of ifs to say literally 100% gain and then give it all back again. That'd be a tough one to wait on. You'd probably wait more than all summer for that. That right there, very, very simple. If you trade your chart patterns on your weekly chart, you can make your entries off the daily, but you're going to have a higher success rate of trading. The thing with it, as I'm talking for summer trading and where you'll see some alterations to my normal swing trading for the summer, is most of the time I'm going to be making my swing trades, 4 to 6 weeks out. And like for right now, I've already started buying July monthlies. When do you think I'll start buying August monthlies? Yeah, I'll be buying the August monthlies probably the first or second week of June. And by the time that the June monthly expires, what expiration do you think I'll be buying? The September monthly. So quite literally, by the middle of June, I'm going to be looking at September monthlies for my swing trade. Now, we've talked about most of my swing trading and how I like to scale into them. We've also talked about how I still kind of want to enjoy some of that higher volatility of trading closer to the expiration. But I also don't want to have the huge risk of my whole trade going to crap if it doesn't move in a week or two. So the way I look at my swing trades for the summertime is I kind of have a core position. Give me just a second. I think I disconnected from chat there for a second, so I gotta get my desktop sharing back up. What I was saying though is for my summer trading, I like to look at like I kind of have a core position. And for that core position, do you think that would be my closer to expiration or farther from expiration trade? Absolutely. It's the one that I know is going to be less volatile through up and down moves. And I should also say that in the summertime, there's only one word to describe the expiration I wish to trade. Does anybody know what that one word would be? Quite literally, from Memorial Day to Labor Day, there's only one word to describe the expiration I'll be trading. Monthlies. Which means if I have, as I was alluding to, a core position, which means I'm going to have kind of a soft position as well. If my core position by the middle of June is in the September monthlies, my soft position, what do you think it would be trading? Yep, I would trade it like I do now, basically, where I would buy the Julys. Now, for my July ones, if I'm holding a core position for September, Do you think I'm going to try to buy and sell on every red and green candle? Or do you think I'm even going to try to concern myself with buying and selling? Oh, no, no, no. I'm basically going to hold that to a chartable point. I mean, if you think about it, GMCR, if you look at this, it would have been hard for a lot of people to hold on the gap down, but in reality, you had no clue how far it could go up before it would just fall again and still hit the target. So to me, for my core holding, you hold for all of that, even if you don't even know if it'll go back down. That longer expiration is going to be less affected by a bounce move like that, right? But with that soft side of my position, what do you think I'm going to do with it? Well, I'm going to be, we'll just say, quicker to trade that one. Now, let me tell you another big difference in how I trade these as opposed to the rest of the year. The rest of the year, if I'm scaling in with 3 buys, each buy is equivalent to what fraction of a total position size? One-third. And I'm telling you, I do plan 3 buys, but it's not even 1/3 buys. What do you think I want my core holding to be, my core position? You're exactly right, Trini. That's where I'm going to make a 1/2 buy. And what do you think, like if I'm making a 1/2 position buy, let's just use simple numbers. If a swing trade position for me is $1,000, how much money am I looking to spend on my core position? And then my other 2 buys, my soft position is going to be what? $250 for each buy. Now, I'll use those buys. They could be like for leverage, like, you know what, maybe over here after the dip, it's like, well, it's still a head and shoulders. I think it'll go down. I might have taken one of the soft buys here, and then it pops up again. Well, I'll waste that other buy on that. Do you think I'd really care much about a calls buy here today? If I'd have bought a 1/4 position in calls and I had 3/4 in puts, do you think I'd care about that 1 calls position? Oh, I don't think I will either. But I'm definitely quick to leverage what I believe to be the overall trend with those smaller buys. But I also look to trade those more frequently. And by that, what I mean is like in the incident of this happening, this gap down. Let's say, for instance, I had September puts and I also had June puts. The September puts I'm holding for my target area at least. What would I have done with my June puts on the gap down? I'd have sold them. And it's not because gaps have to fill themselves. There's just a higher likelihood after a gap that you at least make some move in the opposite direction. So I'd have sold the one that had less time remaining. And Trini, that's a problem that is most people's problem. And you've got to be able to identify why that's your problem. People struggle selling because they don't know if they could make more or not, right? I don't sell because I was wondering if I could make more, and by the time I thought about it, well, then I was just hoping it'd go back up to what it was so I could sell it. Well, and see, you'll actually find, Trini, that it's my own struggle with that. That is actually why I enjoy scaling into my trades. Because if I scale in, I also do what? Scale out, right? I tell people all the time, you get a second buy in something with me, you automatically set a good till canceled limit order for 100% gain, right? I say that all the time with the swing trades. By the time you get the second buy. Now, Trini, what that does is it helps me with my own problem that you and I share, okay? That problem that you and I share and every single other person in here shares, because it's hard to sell because you don't know if you could make more money. So I sell half of it, because if I could make more money, I'm still in the trade to make more money, right? And the same goes for stopping out of a trade. By the time I get my second buy in it, I do have points on my chart that I'll stop out, but do you ever think I sell the whole thing? No, because you know, what if it does come back? So I stop out a half of it. That way, if it doesn't come back, I don't completely screw myself. You see, the funny thing is as far as trading experience, this, that, and the other, or experiences we have in trading and emotions that we share while we're trading, you, me, and anybody else in here is probably no different. And that is the truth. Selling is the hardest thing to do as a trader. So I simply just never sell at all. Usually by the time I do sell it all, it's because I know I should have sold it already. Well, yeah, Leonard, we know you're a little different. That soft position, though, the one I would be trading closer to the expiration time, that's the one I'll actually trade a little bit to. And the reason is because even though this particular move just happened to be $10, most of the time in that case it'd be a more subtle move. And I could take advantage of the ones that just went up a whole bunch on a $20 drop, $15 drop that are closer to the expiration. And also, what's generally going to happen by that time? Let's think about it. Some of my positions actually going to probably be paid for, isn't it? Chances are that remaining portion of my trade at a time like that is probably free. It's actually really easy to trade a free position. If you really think about it, it's fairly easy to trade a free position. Why is it easy to trade a free position? Well, why is there less emotion? Why is there less stress, which would be an emotion? Well, exactly. You can't lose, and anything you sell it for is what? It is the profit. So never, ever, ever be afraid. I mean, I've got a rule with the people that work here in the office. If you see 100% gain, you sell half. And if you tell me you just made a 400% gain on something, you better end that statement with, I just made a 400% gain on half of what I bought. Because at 100%, there should have only been half left. Does that make sense? That's a rule I have for my traders here at the office. I'm actually concerned if somebody comes to me and is like, oh, I just had a 250% trade. Well, that's good, but you sold half at 100%, right? And if they say no, I'm concerned because it tells me what? I wouldn't say too greedy. Well, they're not listening, but they're also risking my money. That's what it really comes down to. But, you know, those are just simple rules that I have here, but I do it with my own trading. You know, an option swing trade, unless you're just trying to trade every green candle and red candle, is not hard to make 100% gain. Matter of fact, on a swing trade, any gain less than 100%, it's not even worth talking about. You actually find if you're not just trying to force it, on most stocks, you would probably average 125 to 150% on most of your swings. So 100% is really not greedy at all. It's just smart to sell half there. Now, another thing you guys will often see me doing during trading hours in the chat room is looking at what time frame a chart. I look at it all the time. I talk about it all the time. A 15-minute chart. Actually, I don't personally do any trades off a 10-minute. I put that one up there just because of a lesson that I did on trading that chart, but I don't trade that chart. So it's actually just wasted real estate on my monitors. But a couple people asked for it, so I keep it up there for them. My day trades literally all come from a 15-minute chart as my lowest time frame. Why? I can trust the patterns on a 15-minute chart more than I can a 5-minute. I see plenty of W's and M's and whatever else on a 5-minute that move like barely at all. You know, last week I think it was, people were talking about this W coming up on Apple's 5-minute chart. And then I said, yep, well, there's the buy, and like 8 cents later, there's your sell. It hit the highest close after the start of the fall, and then boom, it started falling again. But it traded just like a W would. The 15-minute chart just actually gives me better trades, I found. During the summertime, I actually don't focus as much on the 15-minute chart, but what chart do you think I do focus on? If you guys were here last summer, you'll remember me trading Facebook a lot with this chart. In the summertime is the only time I really talk about it. Yep, the 30-minute chart. I just said I knock all of my time frames back one, right? Do you know how else I look at trading? Oops. With that 30-minute chart? The summertime is actually one of the few times you'll see me put one particular charting tool up on my charts regularly. By regularly, I mean pretty much all the time for any shorter term trade I'm going to do. Channels. And I can also tell you, after this week, there will only be one day each week you see me buy something that expires during that same week. What day would that be? Friday. Why? Because stuff does not have to move very far on a Friday for you to have a good shot at making money. So I'm going to take advantage of that. But you will regularly see me all summer long taking my day trades, but using the following week's expiration for quite literally day trade opportunities using next week's expiration. Why? Why do I want to use next week's expiration? Well, you guys remember how we talked about in last week's lesson the danger of holding a trade overnight if it expires the same week? You guys remember that conversation? And then today we talked about it more in the chat room when we were talking about one particular instance that we all got to learn from live. And then when I started this webinar, I talked about the occurrences of times where you could actually gap and go flat. So trading the extra week gives me the ability to do what? Hold up. Because if there are going to be days that actually will happen frequently where, you know what, we might go up every single day all week. And you could see people that hold weekly calls overnight. By the time Friday hits, it gaps up, goes flat each day, and they break even, maybe make a teeny tiny amount, might even lose money because they were trading the weeklies and hold them overnight. But trading the following week, if you do gap and go flat, you still have a very, very, very high likelihood that so long as it's gapping and going flat in the direction you're trading for, of making a significant profit. Why do you think I want to use my channels as opposed to, like normally I would use Fibonacci extensions or swing points? Well, swing points and Fibonacci extensions will help me trade direction too. But let's put it this way. No matter what it is, no matter if it's an indicator I put on my chart or something I draw on my chart, what is that I put on my chart? Well, it answers the questions, when do I buy and when do I sell? Wouldn't you say those are probably the two most important questions for any trader? Probably the two most frequent questions people have. When do I buy it? When do I sell it? Well, you see, if I'm using Fibonacci extensions, if I identify a lower high after a lower low, okay, I make my buy, where do I stop? No, that's my target. Where do I stop if it's not going the way I wanted it to? The zero line. Unless you're day trading like most of my day trades where I'm willing to lose 100% of what's in it, which is perfectly fine so long as you're actually willing to lose what you have in it. Most people will hear me say that, but they're not willing to lose what they have in it. So now, what I have here is, even though Fibonacci extensions is a non-linear charting tool, it still gives me a linear stop point and a linear target point, doesn't it? When I put channels on here, what do I get? And I'm more concerned with the relation to my stop. If this upper channel line is on my chart, what is it for a puts play? What is this upper channel line? It's a stop that gets lower with every passing candle, correct? If I bought because it fell, it hit that line, well, I just made the line, but now it's pulling back, and I assume that that's the channel it's going to trade in, each candle that goes by, my stop gets lower, right? Which is going to help me do what? If I obey my stop, what does that mean? Let's put it this way. Right now, it could only go sideways until 1:30 tomorrow. Why could it only go sideways until 1:30 tomorrow and me still be holding puts? Why is that literally the longest it could go sideways? Well, exactly, because if it kept going sideways after 1:30 tomorrow, it'd be out of my channel, wouldn't it? Because the 1:45 candle, or sorry, the 2 o'clock candle on this half-hour chart, if it's still sideways, it's above my stop. So the directional channels actually help me do what? Well, they don't help me sell. I still have to push a button. They help me not get stuck in what? I mean, Leonard will tell you, last summer we traded Facebook. We bought that son of a gun 10 minutes after the open every single day, and we sold it when, Leonard? From Easter to July 4th, every single day. We sold it at 11 o'clock. Why? It was always the first stock back then that would start going sideways, and it did it at 11 o'clock. And we found that too many times, if it were to break out in the afternoon again, it would still be at a lower price for the contracts than what it was if you would have just sold it at 11 o'clock before it started consolidating. So your channels actually assist you with not getting stuck in consolidation. And then all you have to do is what? All you have to do is what? React, right? If it goes above my channel line, I need to do what? If I'm in puts right now and it goes above the top channel line, I do what? Sell. And if I choose not to sell, I do what? Why would I say if it closes above? That's a wick. That's a wick. Those are absolute prices. That channel is no longer valid if I put a wick above it. That doesn't mean it might not come back down a little bit before it goes up again. But if it puts a wick above your channel line, guess what? Even if it pulls back, you just got your indication things are about to change. It's no longer the trade you were making. But if it goes above my channel line and I do not stop out of the trade, then what? Then I made a conscious decision that I'm willing to lose it all, right? If it goes above my channel line and I fail to react, then I just made a conscious decision that I'm willing to lose it all. So if I'm not willing to lose it all, and I know hope is a bad thing to trade on, if I am not willing to lose it all, I need to do what if it goes above that upper channel line? Sell it. So now let's say in the case of this trade here, I was trading the May 29th $80.50 puts. If I'm using Thinkorswim and I right click on that top line and go to create alert withdrawing, I'm going to say crosses above. And here's going to be my note to myself. Now, I don't mean to make this sound like a joke or even offend anybody, but I'm going to show you quite literally how I use my broker alerts. In case you can't see it, I might type something that says sell Facebook 529 8050 puts or be willing to lose it all. Why would I actually type that? See, a lot of people on their broker alerts, they just set a broker alert, but they don't give themselves an instruction. And then they get the broker alert and they're like, what did I have that broker alert set for? More commonly, what my broker alerts would say, if I actually take the time to set it, it's probably because I'm not willing to lose it all on that one. I will actually, because, you know, TD Ameritrade will actually text message me and email me exactly what's in that alert note. I'll actually say, sell Facebook 529 8050 puts, or you're gonna F this one up. I got it turned off on this particular thing, but I go here to show alerts, you'll see that, see how that changed the coloring to yellow there? It's actually going to move in value to that line. It's not a fixed price, it's fixed on the line. Because let me tell you this. If I wasn't willing to let this come back up to that line and touch it, then I should not do what? The trade. So it should be no problem for me to sell it if it goes above it. And I make my broker alert actually tell me the exact instruction. Because have you ever gotten a broker alert and then it's like, whoa, when the heck did I set that broker alert? Or, dang, what's that for? You ever had that happen? Come on, if you've ever set a broker alert, it's probably been that way. You set one and 3 months later it goes off and you're like, when in the heck did I do that? And so then a lot of times you can become a little bit complacent to your broker alerts. You see, the other thing I like about the broker alerts or they all go off at the same time and you're like, whoa, I had a broker alert for something to fail something and everything seemed to fail it on the same day. You know, if I go back here, crosses above, type that note back in because I deleted the other one on accident. You see, you can actually change the sound. Yes, I was going to get to that too, Scott. But you can actually change the sound to customize it to more important ones for you. Like, okay, a bell, I'm just going to know it's something I might want to check my email, blah, 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 blah. But you know what? If I do the ring, if I hear the ring, I need to look at that one right away. What Scott was talking about is I could right click on this alert and create a custom cell. Right, Scott? That's what you're talking about? Once I've created the alert, I can actually create a custom cell. Now look at was right click, cell custom. If I go over to sell with a stop, I don't always like how their orders are set up. But I can set it up to quite literally sell at market. And to be honest, if I was trading one that had good spreads like Facebook, usually a penny or two spreads, I'd just sell it at market if it did that. Breaks that line, sell it at market. Why? Because me entering it right now would probably be making a better decision than when I'm watching it do it. You guys ever have that happen to you? You plan a trade and you're like, okay, this looks great, starting to go down. I got a little channel. If it goes above that line, I'm out of it. Longer I'm in this trade, the better. Because the longer I'm in this trade, the further down my stop is. And then it breaks above your channel line, and what happens? What happens? Yeah, you go, oh man, it broke above my channel. I didn't really want it to break above my channel. Should I sell it or is it going to pull back a little bit? And then all the while, what's happening when it does that is you're trying to think about it. You're thinking about it and you're thinking about it and you're thinking about it. And then it never fails. This happens, right? Isn't that what seems to happen while you think about it? Your inputs, it broke above your channel. And at the same time, what seems to always happen when you do sell it? Seems like that always happens when you actually do sell it, huh? You ever feel like that? When you actually do make the right choice, it turns around and does that on you? Am I the only one that's ever performed a trade before? I guess I'm the only one that's ever happened to. Dang. Well, I can tell you, in those cases, Catherine, see, you probably think about it right now of, well, I'm not going to stop out because the last time I stopped out, it fell again, right? That's how you think about it in that particular situation? And I'm just assuming that because I'm no different than you. And then because you didn't sell, well, guess what? It didn't do what it did last time you sold it. It just shot up. So here's how you got to think about it. What hurt worse, the times you did sell or the times you didn't? What hurt worse? There you go. The times you did not sell hurt you worse. And that right there, Catherine, your statement right there is all the more proof you need of why it's still always going to be a better scenario for you to sell in that case than not to sell. Now, I also want to tell you, for my summer trading, one thing will not change about something I always look to do when I'm trading. Do you know what that one thing is? Yes. We expect these trades to take advantage. I call them pop trades. 1 to 2 days, well, 2 to 3 days. First day being day one, and the pop comes from, if we're gapping and going flat, give me the pop of the first gap, the pop of the second gap, and then I'm selling. And I've actually, that's one thing I've always called those as pop trades. Give me the 2 pops. Pop, done. But do you know what the one thing that will not change about my trading for the summer? Well, I mean, of course, I always chart my trades. Do I like to just have one trade on a stock and then sit and watch it? Well, and one thing you won't find, you know, when I say stacking, I'm taking a multitude of trades within the same trading system in the same move type of thing. I would say more fitting for an answer for that is a multitude of trades on the same stock. What I mean by that is there a likelihood that it could break above this channel but still be in a down channel? Is that possible? That Facebook could break above this broker alert I have? Yeah, because look at this. Oops. Go back to my channel tool. Now, would I be looking to enter both of those trades at the same time? No. See, if I was on this bigger channel here, I'd have probably been entering it like right here. Once I identified, hey, I'm breaking down below this consolidation here. And dang. Okay, now I know where my stop is. And then the second trade I wouldn't have got until after this candle closed. So I'd have probably bought it at the start of this candle. Maybe during the start of that one, who knows? Sometimes I do it a little different. I write that off as I could stop out of this trade, but still stay in the other one. I just had a good question come into me using private messages. Usually I don't even discuss those during the webinar, but I'm going to stop and read this one. I've noticed several times that after putting a channel on your chart, you always put a Fibonacci extension. Why? That's actually a great question. There's two reasons for that. The first is because a channel, would you agree that channel is like a replicating move? That's what you're trading, right? For it to actually stay in a channel, you're making the same distance up as you are down. Would you agree? Okay. So Fibonacci extensions kind of give you that same viewpoint. It's a replicating move. Now, this might sound funny. I actually look at, you see how at the bottom of my screen it says 10 o'clock? Now, that's the opening time for that candle, tomorrow at 10 o'clock, which means it closes at 10:30 from that. Actually means that I'd be looking for it to hit my channel sometime between 10 and 10:30 so I could sell it. Now, do you think that's 100% accurate? Do you think that's 100% accurate that dang, every single time it does that?
Yeah, because look, on the calls trade, it wasn't. It's not 100% accurate, but it's funny how many times it gives you just a rough estimate. And then the other reason is, to be honest, well, actually, there's three reasons. The first one is because many times it gives me an idea of what time it could do it by. The second reason is, does a channel line actually give me a target price? Because if I bought puts right here when it pulled back from that, shoot, my target price on that channel then is 80.48, but by the next candle, it's 80.40, and then the next candle, it's 80.38. So does it actually give me a target price? No. And I like to, if I'm trading out of the money options, I at least want them to do what? Have a chance of doing what? Being in the money at the target point, right? I don't want to trade a $78 put here if it could take 3-4 days to get down to 80.28. So it actually helps me pick my strike. And the third thing is, have you ever seen a stock trading in a channel and then for some odd reason, it does not go to your top line or bottom line, and then something changes? Did we see that on the SPY today? Right when we were talking about a channel that it would have had to go to the top to get that same price it was at yesterday? Oftentimes, you'll find that, let's say this thing is kind of going sideways, and then it bounces down to right here at 12:30 tomorrow afternoon, 1 o'clock tomorrow afternoon, and then just randomly starts breaking upwards again without hitting the bottom of my channel. I've actually found, by correlating the two in my channels, I found that most of the times that it reverses by not touching the channel line, it's actually doing it off of this price at a different time. And the funny correlation with that is, if it comes and bounces just off of my bottom trend line and goes up to here, there's actually a really good chance it's going to stay in that channel. If it reverses not off the bottom channel line, but down here, what do you think that I've found there to be a good chance of happening? That it stops trading in that channel. You know, if it took until 1 o'clock tomorrow afternoon to get down to that 80.28 level, never hit the bottom line of the channel, and then starts going up, where most times I might be willing to hold my puts to let it make the move up and down in this channel, I would sell those there and take my chances of buying it again if it hit that line and pulled back. Just a funny correlation, but something I've found to happen many, many times. Now, when I doctor my chart up like this, what I want to do, because I don't want to clutter my chart. If I'm using the channels and I just have the 100% fib extension to help me pick a strike, is the zero line relevant on my chart? Or would I stop out before that? Exactly. So if it's not relevant, do I even need to have it cluttering up my chart? And the other thing I like to do with my down fibs is I color them red. Just have it. So I could take these 2 0 lines out. Does anybody know why I have this dash line in the center of my channel? If you don't know, I actually have a perfect example to show you of why I have it on there. That happened today in a trade that we were all watching. So if you don't understand why I have it in there, you know, not just the relevance to what we would call the 50% rule and just how many times we see 50% moves and how many times we see funky things at 50%. Heck, this chart made a head and shoulders off your 50% line in that channel, didn't it? And it was this candle where it broke below it. But let's look at the SPY today. We talked about this when it was actually happening, and I don't know the channel that I had on it. Let me delete these drawings. And actually, I think I had a different channel on it. I had a channel from here, which you can see up here earlier. That's where it hit that, just hit the halfway point and came down. But tell me what about this channel right here actually told you that the next up move was not going to be any good and that your channel, you see, if you're trading in a channel, you expect it to go from the bottom of the channel to the top of the channel. And after it hits the top of the channel, where should it go? Not necessarily down, because if you're in an up channel, you can go over. But you're expecting that it'll hit your bottom line before it hits your top line again. That's usually an expectation that a channel trader would have. And then when it goes up again, you're expecting it to do what? It just hit my bottom line. Where should it go now? Did it go back to the top? Actually, a couple times it kind of hit it and pulled back from it, hit it again and failed to keep going. And then at that point in time, when it went back down to your bottom channel line, and it really doesn't have as much relevance with the fact that it only went to the halfway line, even though I would actually use that as a reason to stop out of calls or to sell them. But when it goes back to this line, should it have gone back down to my bottom channel line if it has not hit the top line? So what indication were you actually given here that you might not have seen if you had this channel up on your chart? And this is where a lot of people, I think, do mess up with channel trading, or they don't understand why things change. See, the channel actually told you that you needed to look for something else. And it was actually a change in the channel, right? And at the time it went down, you see, to make a new channel, you have to have an up and a down move. Well, that means you had to go from this up move, the last time I hit that old channel, to right here where it had changed, And now, even though this is still an up channel, would you have then been looking to buy calls down here? Remember, here was the old channel. See, on this blue channel, it looks like any one of these wicks is a calls buy, doesn't it? And yes, you could have made a little bit of money trading the calls. But you could have also, and be honest with me, if you commonly have the problem of only looking at where your target might be, and you're trading this channel, aren't you already looking up at this top blue line? Isn't that the only place you're looking right now? If you bought calls here, you're already telling yourself, I'm selling when it hits that blue line, right? Yeah. When this high right here failed to go up to that blue line, you actually had a change in the trend. That change was still an uptrend. Okay. Oh, hold on a second. I think I disconnected again. I don't know what the heck's up with that. It's making me reload the desktop sharing. Give me 1 second. Probably doesn't help that it says I have updates to do. That's probably why it keeps jacking me around. All right, sorry about that. So what I was saying is that old channel, the bottom line was these wicks right here. But if you identified a change in the channel, would you have been looking to buy calls on this wick right here? Because we already saw what the gain was. Even if you'd have bought the calls down at this wick, you'd have spent 37 cents. We talked about that earlier today. It wasn't until this bottom right here that they were 34 cents. But that wick right there, you'd have paid 37 cents for the calls. And they only got back up to 51. So it's not like it was a huge gain. Sorry, someone came in the office and scared the snot out of me. Anyway, when you change that channel because of the fact that it stopped obeying the channel rules when it did not go back to that old top line, then all of a sudden here is no longer a calls buy. What would you need now to buy your calls? Anybody? Well, no, you already got a new channel. Remember, the old channel was here. This blue one was your old channel. But see, in that old channel, you came off the bottom and never went to the top before coming down to the bottom. So rather than buy calls here, you should have been waiting to buy calls off of this line, right?
Okay. And do you always want to buy like right at the absolute low, or do you want to at least let it make a positive move from it to make some indication that it might hold it? Yeah. So then you go, oh, dang, you're sitting here and it's going sideways. You probably don't feel so bad. And then this happens. You're like, dang it, I knew I should have bought calls. But you still wouldn't have sold it because even here, you'd have been waiting for this line, right? Let's be honest with ourselves. Even if you had this new channel, now you're waiting for this line. But you see, when that time comes that we would normally talk about buying calls again, it would have been waiting for this line to hit and make a positive move from. Would you have then even gotten calls? Not just no, but heck no, right? Now what can we do with this channel? And then to form a new channel, what do we need? We got a down move that failed the channel that was there. So we now need a what to happen for us to find our next trade or our next channel. Yeah, we got to have an up move. Now, so let's just assume, we're going to make an assumption that tomorrow goes down. Wouldn't we have a new channel right here? If it goes down from this point, you know, if the first candle tomorrow comes out red, doesn't break above that, and starts going down, yeah, we have a new channel. Which also means we want to sell it anytime it does what? Where do we want to sell it at? Well, if it breaks above the top line, yes, but when else do we want to sell it? Here, let me make a better example. Remember on the 15-minute chart today when we talked about that trade? I told people when the Momo is no-mo, you got to sell it. You can't sit and say, you know, even if you got a smaller account, or it's like, I can't buy anymore, so I'm just going to hold it and see. Because this is a perfect example why you don't want to do that, because you let a winner turn into a loser. But let's say it comes down and it hits this bottom line. Just making an assumption, just so we can talk about it for our lesson purposes. Let's say it does this right here. And then it does this. Tell me if you'd want to sell it or hold it. If we were in puts, if we bought puts, like if this was the first candle tomorrow and it opened and started going down, and then we said, hey, we got a channel here. Can I ask why you'd want to hold it? How many times have you guys seen a channel look like this and then the next candle look like this? Think about your assumptions with a channel. If it hit my bottom line and started going up, where am I assuming that it'll hit? The top line. So if I'm trading options, isn't the assumption that even if it went sideways to my top line, time would elapse? Think about it. Even if it went sideways to my top line, wouldn't time elapse for it to do that? Okay, let's make another assumption. If time elapse, what happens to options? They decrease in value. We call it time decay. So if it hits my bottom line and makes a positive move up off of it, I assume it's going to go back to my top line. And then if it does, hey, oops. Let's say it only does go to my top line. And then does this. Wouldn't it actually be better for me to buy it back? Because for all the what if traders in the world that want to say, well, why would I want to sell it here? Because what if it just keeps trading down in that channel? There's going to be a pretty good argument of what if that's the last time it hits that bottom channel line? In which case, you could probably just be better off waiting for it to hit your top channel line and buying it again. Does that make sense? Are we making sense? Well, see, in that tight of a channel, I wouldn't have trail stopped it because you would have actually found on any puts play that, like here, your trail stop would have hit pretty much at the top because it only did like a 12-cent difference from that low to that high on the 213 puts. So that means your trail stop, you to put it in at the low, and the minimum trail stop you can do is 10 cents. Well, you stopped out right back at the high. In which case you just stopped out when it could have been your best buy point. Well, and I understand that, but the one thing that people really have to understand, and we can see it on any chart that we go to, do most stocks go straight up or straight down? So in the event that you have a stock that's making higher highs and higher lows, and then all of a sudden it makes a lower low, even if it might look like it's making a big drop, do you think there's a chance it'll ever make an up move? Yet still actually maybe continue downwards? And the point I'm making with that is if you've got a stock that's making higher highs, higher lows, like this one we're looking at on this chart, very rarely do you want to make the first trade in the opposite direction.
more times than not, you'll be better off saying, hey, it's not making higher highs and higher lows anymore. Made a lower low, so what am I looking for? I'm looking for puts, but when? Well, if it goes clear back up to the top, it wouldn't be a lower high. I want to be able to identify a lower high, but not try to call the high. You know, if it was going to start pulling back from here, let it put in a red candle. And then when that next candle opens, if it just barely starts continuing down, take it. But if you're already in a sequence where you got a lower high and then you made profit on that puts play and then it comes up again and it's making another lower high and starts pulling back, well, then you can not necessarily wait for that one candle to close to confirm it. You can say, hey, I'm starting to get a red candle. I'm going to take my chances. The point of tonight's discussion for me was to kind of explain a little bit of what you're going to see from my swing trades and my shorter term trades. The reason I chose today to discuss this is what? Why did I choose today to have this discussion? And no, it's not because Sam only has like a 30-second attention span. It's because by the time we have the next webinar, you'll be wondering what I was already doing. You know, markets are closed this coming Monday. Tuesday, we'd come out and you'd be like, why the heck is this guy alerting like frickin' September monthlies? He completely skipped over August. Or I might do some August and you're like, whoa, 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 wait, I thought we were going to trade July. Or I might actually discuss a trade on something I'm seeing on a chart that normally I would discuss it as a day trade, and I'm saying next week's options. And then you're going to be left scratching your head going, So the point tonight was to actually exhibit to you what my trades will look like, but also my swing trades are my bread and butter. Any trade I ever make shy of a month out, that's pretty much considered a day trade to me. And it's teeny tiny and I'm willing to lose all of it. Swing trading is what feeds my family. I guess you could say the pizza shop I got is what feeds my family, but swing trading is what feeds my family. Swing trading has always been my bread and butter. It's just a slight altering of my swing trading based on statistics and regularities and things that just always seem to happen. And a knowledge of knowing that summer's going to have a little bit less volume, But at the same time, let me tell you something. Let me tell you something that I also think is very, very important. Is that there's still going to be day trades to be made. You're going to want to be more careful, and you're also going to want to be willing to take profits faster, even if it does keep going in a direction. What I mean by that is those little rules we've talked about before for day trading, like, hey, by 11:30, 85% of stocks or more either pull back or go sideways. What would that tell you about any morning scalp? Any morning day trade you made? What do you want to be really careful to do by probably about 11:30? Sell it. And honestly, for those of you that say, well, let me tell you what, all year round, 75% of your volatility for the day is going to be made in that first hour of the day, which is why our day trading small group is open the first hour and a half to 2 hours of the trading day. In the summer, it's even higher of a percentage, probably closer to 85 or 90%. And those of you that want to do some trading, but it's going to be slow and you don't want to be bored, the day trading small group would be great for you. Why? Because I doubt Coach Cliff and Coach Nina will pull too many days past 11 o'clock this summer. Because in the summertime, you really want to treat the trading day like it's 2 different days. You got your first half and your second half, and you do the trades exactly like that. I want to be out of my morning trades before the morning's over. And I want to be out of my afternoon trades before the close. That's why a lot of day traders, their hours are like 9:30 to 11:30, and then they're off, and then they work from 2:30 to 4. Thursday is the best of both worlds day, Michael. For day trading, Thursday is the best of both worlds. A lot more safety than Friday, and a lot more volatility than the rest of the week. Thursdays for day traders, that's day traders' dream day. I was actually talking to somebody earlier that said, hey, I've only got Thursdays off. Would the day trading small group benefit me? And I said, if that's the only day I had off, then that would be the day I'd be there. Yep.